Hi everyone, this is Tyler from ORATS and welcome to our Indicator Spotlight video series, where we break down our most popular proprietary indicators. Today we'll take a look at one of our core indicators, combined with a ratio to both its 50-day average and the IWM ETF. We'll go over what this indicator means, how it can improve your backtest results, and how it's calculated. Let's get started. On my screen, I have the backtest report for a long call spread on Snapchat. I added some parameters like spread yield percent and the stop loss, but no indicator triggers. I ran another backtest with the same parameters, but added the indicator trigger in hopes of filtering out some bad trades. If we compare the results, we see some distinct advantages in the indicator trigger backtest, such as lower volatility, a higher worst annual return, and a higher strategy win rate percentage. The annual return was slightly lower, but that can be attributed to the strategy being in the market almost 10% less often than the one without any indicator triggers. Taking a look at the monthly breakdown of returns, we see that 2018 was a bad year for this backtest. But if we add the indicator trigger, we see that it avoided some critically poor trades and actually flipping 2018 from a negative annual return to a positive annual return. To understand what this indicator means, let's break it down into three parts. The first part will be our base indicator, which is defined by this equation. If we break this down into its individual variables, we get the following. In the first half of the equation, we are comparing the stock's implied volatility to its historical volatility. In the second half, we make the same comparison, but with the stock's best related ETF. For example, if we are analyzing Snapchat stock, ORATS would use IWM, which tracks the Russell 2000 index. Let's move on to the second part of the equation, which is the ratio to the 50-day average. This simply takes the first part of the equation and then divides it by the 50-day average of itself. The purpose behind this is to see how the indicator is currently performing relative to its recent history. The last part of the equation is the ratio to IWMC, which is ORAT's component-weighted symbol for the Russell 2000 index. It does the same calculation as in the first two parts of the equation, except with IWMC as the symbol instead of the stock. It then divides this into the result from the first two parts of the equation. Essentially, this indicator identifies when the stock's implied volatility to historical volatility is trending higher than its peers. For Snapchat, this is bullish for the stock and the long call spread test in question. We found this indicator in our optimization process. This indicator is one of our most important indicators as it is identified on many other optimization processes. Let's explore how to add this indicator trigger to a backtest. While creating a backtest, click the Entry Indicator Triggers Edit button in the Additional Parameters tab. Click Edit on the first indicator that pops up to change its value. Search for the indicator you'd like to add. To add the comparison symbol, enter the value in the second text field. In this case, we would enter IWMC. We don't need to enter anything in the first text field since it will default to the symbol we are backtesting on. Finally, set the min and max values. Leaving a field blank will default to null. Make sure to edit the exit indicator triggers as well. Let us know what you think of this indicator in the comments below. And please subscribe to our channel if you would like to see more breakdowns of ORATS proprietary indicators. Thank you for watching, and I'll see you next time.